All right, so welcome everyone to Trends 2023. This is a data-driven and chart-heavy collection of eye-popping insight that hopefully will help you make money in what I call a severe housing recession and help you focus on brand new opportunities that this housing recession has created. We're data scientists. We look at today's real estate market with both a mixture of amusement and also disbelief, almost complete disbelief, and you're about to find out why. So I'm actually suffering from whiplash because 2021 was the single most profitable year in real estate history, best for single family, best for multifamily. And from those heights, we came into 2022 and everything changed for us in an instance. And now we live in a new normal that's so bizarre that we call it unreal estate 2.0. There's an enormous amount happening, and all of it somehow affects real estate. And we're going to tie it together today and make it easy for you to understand the impact on both multifamily and also on single family real estate. And once you understand the full impact, we're going to look to the future. Our economic forecast for 2023 is going to cover it all: GDP, recession, interest rates, unemployment, inflation. And then we're going to show you how real estate, single family and multifamily, is likely to perform in this environment. And we'll finish the presentation with a shootout. This is for the 8th year in a row. We will share the analyst picks for best cities and states in the US for real estate investing. And I'll also stick out my neck and give you my top pick for best city in the US to invest in, just so that you understand some history for you. The first time 8 years ago I picked the best city in the US to invest in, it was Provo, Utah. Isn't that cool?
That is cool.
Yep. And for those of you that don't know me, I am a quirky and opinionated data scientist and technologist who buys and builds large projects. So my portfolio of 31 properties is worth about $1 billion. 900 data-driven and nerdy investors have trusted us with their money. Here's about half of our portfolio. You'll notice some buildings in Utah. We use data science to invest in 8 different asset classes: multifamily value add, multifamily new construction, single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self storage, and also flex industrial. And each of these asset classes taught us something different and made us better at our job, which is to protect our investors' money. We've now gone full cycle 7 times on these projects, and we have an overall IRR of 35% and average annualized returns of 47% across those 7 exits. Here's 2 value add projects that we exited last year. In each case, we more than tripled the projected IRR returns. And our investors, they love what we're doing. Here's Jennifer. She is a super experienced investor. She's in orange, comparing us to much larger companies with more projects, and she thinks that we come out ahead. Here's Dr. Pada. He's a general partner with lots of deals of his own as a general partner. Check out his comments in orange. So it comes down to true use of data to optimize results, and we are very, very good at that, and that's why Dr. Pada and other investors keep coming back to us to invest. Let's get the boring legal stuff out of the way before I dive into the good stuff. This is a friendly reminder that the webinar is for educational purposes only, and just because I'm sharing my personal opinions, it doesn't mean that you're guaranteed to make a fortune in real estate. Do your own research, consult professionals, and remember that investing is risky. And do not be shy to type in your questions. It might be more useful to type them in the Q&A box, because once I answer them, I can check them off. So if you can't find the Q&A box, try the chat box. And I believe that this is now being recorded. Yes, looks like no. Yes, no.
Yes, it is.
Maybe being recorded. All right, being recorded. All right, there you go. Please tell me that at least half of you get this joke. Stranger things are happening, and not just on Netflix. You know, every slide from here on gets more and more bizarre, just like season 4 of my favorite show. We start Unreal Estate 2.0 with the curse. Yes, the curse of the strong US economy. And most of you are thinking, wait a minute, Neal, don't you mean the blessing of the strong US economy? After all, we've got a labor shortage of 4 million people. We've got the second strongest job growth on record and record low unemployment of 3.5%. We should all be feeling blessed, right? Wrong, because we are in the upside down, to use a Stranger Things term. Everything that was right in the world in 2021 becomes wrong. It becomes the curse if inflation is high. In 2022, US stocks lost 20%. The tech index NASDAQ lost a stunning 1/3 of its value, even though corporate profits are up 25%. And US homeowners are $30 trillion richer than they were pre-COVID. Why? Because the era of super cheap money ended. And it cannot come back if the economy stays strong and inflation stays high. So bizarrely, everyone from a Wall Street broker to a bank CEO to a real estate syndicator, we're all praying for a weaker economy so we can get back on our cheap money cocaine drip. Feeling unreal yet? And in this upside down world, we have to come to grips with two, not one, but two brand new to 800-pound risk gorillas that no one talked about a year ago. The first one, geopolitics. The chart on the left is from BlackRock, the largest asset manager in the world. Geopolitical risk was less than zero here in 2018. But when we ended December 2022, it's the highest it's been for decades. The world is fracturing. It's fracturing into competing blocks who hate each other but have to trade with each other. And we see all kinds of problems with that. So we're going to dive deeper into that geopolitical risk and the impact that it's having on our profits in real estate. But before we do that, let's introduce new gorilla, 800-pound gorilla number 2, and that is labor force participation rate. BlackRock also points out that in 2008, 66% of the adults in the US wanted jobs or wanted to participate in the labor force. Thanks to COVID, we're down to a stunning 62%. According to ChatGPT, who clearly knows everything, a 1% decline in the labor force is 1.6 million people. So we've now lost 6.5 million working adults since 2008. And somehow we all thought that removing 6.5 million people from the workforce wouldn't create wage inflation? How dumb are we as a group? All right, back to the first gorilla. Let's dive deeper into the geopolitics. So 2022 had the second highest oil and gas shock since the 70s. Putin's war took the inflation that was created by the COVID supply chain issues and then it turbocharged it. Massive food inflation, massive energy inflation is everywhere in this world. And without getting into a red versus blue debate, no, I know Utah's a red state, inflation is not a US problem. Helicopter money didn't create our inflation, supply chains did. Putin's war did. Dozens of countries that didn't print a single dollar during COVID, they're facing it, just like us. In fact, half the world has double-digit inflation. Take a look at the chart on the right. As Americans, we love whining about half a year of 9% inflation. Anyone want to live in Zimbabwe, Lebanon, or Venezuela? Not me. I'm going to take the US, political dysfunction and all. A lot of that inflation, it's coming from an energy crisis. And the world is in the midst of the first, not the second, the first truly global energy crisis with impacts that will be felt for years to come. The chart on the left shows how we are hurting the least of any country. In this chart, light purple is good. We are really good. It's dark purple that's in trouble. Europe is in trouble. So on the right, you can see that Europe's natural gas costs are up 6x in a year. Electricity is up 78%. Total energy prices up 2x in a single year. And while we have seen recently some relief at the pump in the US in the last 3 months, it's clear that this relief is not going to last. Expect prices at the pump to go back up in 2023 because inflation is like that old Paula Abdul song. 2 steps forward, 1 step back. And the Fed, they really know that if inflation expectations become anchored, then we are at serious risk of, and by the way, we are at serious risk of doing so. We could be in for a decade of higher inflation because inflation, it's affecting every part of our economy. I've even stopped eating salad because now I have lettuce prices to blame. But seriously, we have a very narrow window to get inflation down before wages go up permanently. Which is why it's so good to see the Fed with such a sense of urgency after having no sense of urgency at all. The yellow line is the change in the Fed funds rate in 2022. And as you can see, the Fed's hiking faster than at any time in recent history. It's a race for the Fed, a race that they have to win, or we are all in deep doo-doo. But all such Fed races, they have consequences. They have collateral damage. In 2022, total US household wealth dropped by a stunning 13 trillion. That's a lot of Benjamins. So keep in mind, though, that this still leaves household wealth adjusted for inflation 10% higher than 2019. And what about home equity? Well, it's still massive. At 71% of the market value of homes is home equity. We're surviving and maybe even somehow thriving in unreal estate 2.0. And do keep in mind that even with my gloomy prediction about oil prices going back up this year, overall the inflation picture, look, it's better. And by the way, I love this movie poster on the right. It's incredible. They even put the names of the Fed governors that are starring in the return of inflation at the bottom. Check it out. Anyway, while it's clear that US inflation has now crested, thank God, the big question is, will it get back to 2%? Economist after economist, Wall Street analyst after Wall Street analyst is warning us it takes a long time to do that. So we will all be living with higher inflation longer than we're thinking. Now, this slide is absolutely critical for investors. So pay attention, people. That blue line at the top is inflation. So over the last year, up and up and up. The red line shows interest rates. So also up and up, but notice much lower than inflation. Now, this chart makes you think, oh no, rates in red are going up. Good times are over. I shouldn't invest. Worst mistake ever. Because, as the title says, this is actually a rare money minting opportunity. Because real interest rates are not up, they're down. Inflation, blue line, minus nominal interest rates, red line, equals real interest rates, orange line. The orange line is at negative 3% today. So you are being paid 3% to borrow today. I kid you not. Borrowing money during high inflation at a negative real rate is always better than borrowing money when the real interest rate is zero, like it has been for years. See this? This is a zero interest rate. And you were fine with investing during a zero interest rate, but somehow not okay with investing at a negative real interest rate. Interesting, isn't it? You know who understands this? The US government. They know that the federal debt sort of evaporates as income taxes go up with inflation. If dumb politicians can figure this out, why can't we? In other words, inflation is not just a wealth destroyer, it's also a wealth creator. As the cost of stuff goes up, the value of the dollar goes down. So inflation transfers wealth from savers to borrowers. And when inflation is high, that transfer, it's also faster. If inflation remains at 8%, you can see on the right here in green, that stuff will cost 216% more in just 8 years. Stuff will cost double in just 8 years. Shouldn't you buy that stuff now? All right, here's time for section 2. We're going to share some economic forecasts for 2023. Remember, these are not real estate forecasts, but most of the real estate forecasting later in the presentation is actually based on these critical economic forecasts. Here is a sobering chart. What it's saying is that the green dotted line is the point at which GDP, or gross domestic product, doesn't cause high inflation. So in other words, most economists believe that we have to get from the red line, which is our current GDP trend, to the green line. That is a 2% reduction in GDP. That's a lot, a whole lot. Now, while we do see encouraging signs that inflation is going down, there is no past precedent of inflation falling sharply without a sharp decline in GDP. In other words, if you're thinking that somehow inflation will keep declining without a sharp reduction to GDP, what you're saying are those 4 famous last words. This time it's different. We don't believe this time it's different. You can get inflation from 9% to 6% with interest rate cuts, but to get it from 6% down to 3% or even 2%, we believe that economic activity, or GDP, has to fall a lot. Ergo, a recession is still a certainty in our view. And the Fed knows that they have to go to infinity and beyond, just like Buzz Lightyear. On the left, you can see the chart that shows rate hikes. See this chart here? That's where they are today, right? And on the right, you can see the latest projections. Today, the Fed funds rate, it's around this range. It's a range, by the way, in case you're wondering. The Fed projects further rate hikes this year, and no declines, by the way. And they project its rate to be at 4% by the end of 2024. Remember, interest rates sit on top of this. And then only down to 3% by the end of 2025. This will take longer. This is why we believe that what JP Morgan is saying above is likely to happen. In the first half of 2023, we expect, and I'm just reading on the screen here, we expect the S&P 500 to retest the lows of 2022 as the Fed over-tightens into weaker fundamentals. The sell-off combined with disinflation, rising unemployment, and declining corporate sentiment should be enough for the Fed to start signaling a pivot towards the end of the year, pushing the S&P 500 to 4,200 by year-end 2023. Where is it today? 4060. So after a 20% decline last year, JP Morgan only forecasts a 3% gain in the stock market this year. Just 3% in a year with 6% inflation. So we're actually losing ground. So if you're a real estate investor or a stock investor, read the tea leaves. 2023 is not a recovery year for the stock market or the real estate market. This is the sideways market with the possibility of a recession. 24 is that recovery year that you're waiting for. Let's look at unemployment, right? So these economic forecasts show a strong Q1 this year, and we are seeing a strong Q1 this year. Here it is. But then they expect unemployment to start dropping or start increasing pretty fast and end up an entire point higher. So from 3.45 to 4.5 by the end of the year. So the big question becomes, is there a downturn projected when this number spikes up here, right? Are they projecting that? The answer is yes and no. While real GDP is forecasted to be negative right here in Q3 and Q4 of this year, it's not going to feel like a recession at all. It's actually super shallow. It's projected to be very short. So it's about as painless as recessions have ever gotten, according to this forecast, which I do agree with, because we looked at a bunch of forecasts, and most economists that believe that there's going to be a recession, they're in a similar range. So close to these unemployment, close to these GDP forecasts. So yes, recession, very painless as recessions go. All right. So I'm done with all of that dense economic analysis stuff. Now for something much more interesting, real estate, right? We'll do a quick 2022 recap, and then we'll get to the business of forecasting both single family and multifamily performance in 2023. So let's start with single family home prices. So US home prices started to fall in June. By October, they were down 2.4%. Doesn't seem like a lot, but we're just getting started. Now, we know that this drop accelerated in November and then also in December, but we don't have those numbers yet. Our guess, we've dropped about 5% for US home prices since June. Why do I think prices are continuing to drop? Well, I don't have price data yet, but I do have pending home sales volume data. And as I'm seeing pending home sales continuing to fall, we're much more likely to see discounts. Now, as the two talking heads on the screen are pointing out, West Coast, especially California, getting hammered. And the Midwest, the Rust Belt, looking fine because their home prices were cheaper to begin with. Just so you know, Utah also getting hammered. So every year, I show the people that watch this presentation 3 or 4 home price forecasts. But this year, I absolutely didn't want to get accused of cherry picking. So believe it or not, we're showing you 21 forecasts. These are 21 different forecasters. And the range, as you can see, is from a 5% home price growth for this year to a 22% price drop. Now, that 22% price drop, it's actually not as bad as it looks because that's their worst case scenario. But I wanted to show you the best to the worst. Now, keep in mind, only 4 of the 21 sources on the screen predict price increases. 17 of them predict home price declines. In other words, no one really has a friggin' clue. But we're pretty sure that home prices are not going up 5%, Realtor.com. So please stop drinking the Kool-Aid because it's rotting your brain. Now, it's super important to say this. Home prices are not falling everywhere. In fact, as you can see, they're actually not falling in the majority of the country. So if you look at the map, blue means no drop, red means a drop. The darkest red is 10%, and the table on the right shows 10% in only one city, that's Austin, right? Now look at the map again, and you'll see the red is all along the western side of the US. So Washington State, Oregon, California, and then Nevada, Arizona, Utah, and Idaho. So these are basically the only places where prices are falling, with a little bit happening in central Texas. Now this chart might make people nervous about real estate. Is a crash coming? And while this chart is factual, it is extremely misleading. Because this is the reality of real estate. Home prices absolutely exploded post-COVID with massive increases in every state in the country. Just to give you an idea of how massive the increases were, we just saw Austin's drop 10% since June. But the orangish bar, shows how much Austin prices went up in 2 years. A staggering 75% in 2 years. Even after retrenching, they're going to be about 57% higher. Let's say they go down another 20, another 10% beyond the 10% that they've already gone down. So even if Phoenix and Austin and Salt Lake and some of these other places give up some of their gains, they would still be up about 40, in some cases 50% since COVID. That is a stunning gain. And that is why not one of those 21 forecasters that I just showed you are projecting a housing crash or projecting foreclosures, because home equity in the US is at record highs. And even if prices decline another 10% from here, they would still be massively higher than pre-COVID. So by now, you're probably wondering, Neal, okay, fine, housing recession, but not housing distress. I get it. What's my opportunity? Is it just that I'm buying a dip? No. There's a larger opportunity that was caused by COVID and has actually worsened over the last 12 months. This opportunity didn't exist 12 months ago. Let's take a look at it. To understand this opportunity, let's read this tweet. So Ali Wolf is chief economist at Zonda Research, and she recently tweeted, our data is now capturing a 70% cancellation rate in Phoenix. She's talking about single family new construction homes. So 7 out of 10 buyers are walking away from their hefty deposits to buy a new construction home in Phoenix. 7 out of 10. And that tweet brings us to the opportunity for you, single family investor, multifamily investor. Now, every investor knows that we have a shortage of housing, right? Somewhere between 3 and 5 million units. And if we don't want that shortage to get even worse, we have to keep building homes at a certain rate. And if we don't, we'll continue to make the problem worse, and then rents will keep spiking as they have. Except when interest rates are high, buyers stop buying brand new single family homes because they're the most expensive. The nation's big builders are now reporting their quarterly results, and they're sharing catastrophic data. Home buyers are canceling 50, 60, even 70% of the deposits that they put down for new construction single family homes. And you can see the impact of that on the blue line. See it right here on this side of the graph? Home building in the US has already gone down 32%. And we think Q1 data is going to show another massive decline, maybe down here, right? So home builder confidence, which is shown in this red dotted line, went from a rating of 90 to a rating of 30, which is a panic rating. And that is your opportunity. If we build hundreds of thousands of homes less each year in the US for 2 years, we will increase the shortage in the US by a minimum of 500,000 homes. Where will those families go? Well, they're going to rent. And rent is all that investors care about today because rent equals cash flow. Which brings us to by far, the most important slide of this presentation. As a landlord, as a rental investor, we all intuitively understand that if the monthly payment of our home is lower than or equal to the rent, then people will buy homes. It's cheaper. And if the monthly payment is higher or much higher than the rent, then people will choose to rent because they can't afford that monthly payment. So every real estate investor should be obsessed with knowing where is that rental payment versus mortgage payment dynamic to figure out if they should even invest in rental real estate. Today, my friends, that dynamic is massively in favor of landlords. Yes, more in favor of landlords than a year ago. Look at the chart on the right. Okay, the gap between rents in green and home prices in black is the highest in history. It's higher than 2005, 2006. It's higher than 1999. Even though the green area does show this spike, you see this is a pretty big spike, biggest in history. But look at the spike in mortgage payments. Not only did home prices go up, mortgages doubled. So the combination of higher prices and higher interest rates actually make it absolutely the worst time to buy a home in history. And smart investors, they know this. The big investors are doubling down to buy apartments. That's the dark blue line. Notice it's not tapering off. And with the work from home debacle, the big investors are no longer interested in buying office buildings. That's a red line and it's flattening. With the explosion in e-commerce, the other asset class that investors are buying is industrial warehouses. That's the light blue line. Look, also going up. But understand this, the apartment industry is 10 times the size of the industrial segment, and it's still growing at an absolutely spectacular rate. Still growing. Why? Because these institutional investors, they know that single family construction has already crashed over the last 6 months, creating a supply hole of somewhere between 500,000 and 600,000 homes. And that will create 500,000 brand new forced renter families, probably a lot more than that. And those same savvy investors, they know this critical chart. Most of you don't know this. History clearly shows that when inflation spikes, rents spike. The left side of the chart shows the dark blue line. It might look black to you, by the way. You can see that the inflation spike from 1974 to 1984 led to a decade of massive rent increases between 6% and 12% a year. That is 3 to 6 times the historical average of 2% rent growth in a year. Now notice, as inflation dropped down in 1985, rent growth dropped. And it dropped to the 3% range, and it lived in that range for more than 3 decades until COVID and work from home drove it up to a shocking 15% in a year. Savvy investors know that inflation cannot be killed quickly. It will linger for years, which is why they already know that we have above trend rent growth in front of us. Not in 2023, but in 2024. And we just showed you 2 slides ago that apartments are the favorite asset class for institutional investors. But these gluttons, they can't find enough apartments to buy. So guess what they're buying? Single family homes. Now in 2022, institutional players in the US, big dogs, owned 700,000 single family rental homes. Guess how many they're going to own in 8 years? 7.6 million. That is a 10x growth. Yes, they're not buying this year, but they'll buy next year. Let me repeat that. 10x growth in 8 years. They're coming for you, Mr. Landlord. And when they attack with this kind of aggression, with the kind of money that they've already raised, they will drive up prices in 2024, 2025, 2026, not in 2023. So it's probably good for you to know where these big investors are buying. Well, every institutional investor looks at the annual U-Hold report, which shows where people are moving to. And that list is on the right. Utah used to be there for 4 years, by the way. It's dropped off the top 10. Texas and Florida champions for a decade. South and North Carolina, they're racing up the charts. Tennessee and Arizona, they're holding their position. They're sort of where they were. But look at Georgia, particularly Atlanta, racing up the chart, right? So it's jumped up from 23 to 8. And then big surprise, number 9, Ohio, low growth Rust Belt state, now benefiting from the return of manufacturing to the US. So these are good. Now keep in mind, Utah's close by. It's in the top 15, but not in the top 10. Idaho also at some point was in the top 5, but it's dropping down to number 10. All right. No analysis of real estate is complete without multifamily forecasts. Well, we found the various multifamily forecasts for once to be fairly consistent. So we're using Freddie Mac's forecast on the screen instead of showing you 10 different forecasts. Freddie Mac saying that with high inflation, there should be still some positive rent growth in 2023. Yes, we've got affordability challenges. Yes, we've got a potential recession, but they still see gross income at multifamily properties going up by 3.5%. Remember, inflation is at 6, so this is actually negative real growth. But on a nominal basis, still up 3.5%. They do see the vacancy at multifamily properties going up just a smidge, just a smidge. It's I think at 4.8%, so it'll go up to 5% by the end of the year, 5.1. Rent growth is expected to be strong at almost 4%. Though keep in mind, 2021, 2022 rent growth was way higher than the 3.9%, so definitely slowing. Now, lastly, they do warn that construction levels in the multifamily industry are not falling as quickly as the single family market, so expect downward pressure on rents from new construction, especially at the end of the year. For those of you in Utah, both Salt Lake and Provo are likely to feel that pressure early next year. A lot of new construction. All right, where is income going to grow and where is it not? Freddie Mac expects that income growth is going to be strong in Oklahoma, with both Oklahoma City and Tulsa in the top 3. Otherwise, the income growth charts are dominated by Florida cities. So we got West Palm Beach, Jacksonville, Tampa, Fort Lauderdale, Orlando, all expected to see strong but single digit rent growth. The days of double digit rent growth are gone, I think, for a decade. On the right side, you notice that all the cities in the red list, none of them have negative rent growth. They all have positive rent growth. It's just in the 1 to 2.5% range. So no cities in the US are actually expected to see negative rent growth in 2023 in Freddie Mac's forecasts. Just low growth, not no growth. And so I'm going to end my real estate, flashback and tomorrow section with two thoughts. First, just remember this. We need 4.3 million more apartments by 2035. And I do expect price declines in apartments in 2023 because of high interest rates. Nothing changes the overall need that's on the screen. Once the economy corrects, once inflation drops to a reasonable level, we still have a huge shortage. Don't forget that. There's panic makes you forget fundamentals. Here is my second, and this is the most important one. This is the one you show to investors. My second and final thought on real estate. Home buyers just had the worst 12 months in their history. This table, it's stunning. It shows the income change needed to buy a home. Just over the last 2 years, just over 2 years. In Tampa, Florida, you need to make 123% more to own a home today compared to 2020. Your salary probably went up 10%. In Austin, you need 116% higher salary compared to 2020. You probably didn't even get to 16%, let alone 116%. And if you think I'm cherry picking cities, just ignore the rest in the table. Just look at the last line in green. That is the United States of America. And you need an 88% increase in income compared to just 2 years ago to own a home. This is devastating. This is mind numbing because an entire generation of Americans, nearly 30 million families, will never buy a home. Never. And while I see this as one of the greatest tragedies of our generation, it's also obvious to me that this is one of the greatest opportunities of this generation for landlords. The question is it obvious to you? One more look 88%, 2 years. How many people in this room have gotten 88% raises in the last 2 years? All right, I love this music. Time for the shootout. But before that, just 30 seconds on opportunities that you can participate in if you're a passive investor with YouGrow, with Grow Capitus. As you can imagine, we buy multifamily. You saw that gap between median rents and median home payments. It's the highest in history. You saw definitive, undeniable proof that 30 million Americans will never be able to buy a home. Knowing that rents go up faster when inflation is high, it makes sense for us in the second half of the year to buy multifamily properties and improve them. We're not going to buy in the first half because we think their prices are too high and will come down. So we have value add projects available. You can invest in a fund, and that fund will then buy in the second half of the year, and you can get information. We'll send you information about it. We're only buying 1 to 2 value add projects a year. In many markets, value add prices are still far, far too high, abysmally high, by the way. In those markets, it makes a lot of sense to build a brand new asset rather than buying a 40-year-old asset. Like this asset, it's townhomes and apartments in Utah, in southern Utah, in St. George. So we're continuing to build apartments in several metros, and you can get information about open projects through us. And if you're a savvy investor, you know that there are zero value add projects in the US that anyone is buying today, just today, now, that will cash flow in the next 2 years because interest rates are so high that all the money is just going to go to pay your interest payments. So if you are a cash flow investor, maybe you should look at this kind of offering. In 3 months, you'll see an offering that pays you 11 to 14% cash flow, monthly cash flow, immediately upon investment of your funds into a property and still gives you the ability to get some back end profit. No one in our industry offers 11% monthly cash flow, let alone 14% with an equity kicker on the back end. So this is a product that will be available in about 3 months. And we know that not every investor wants syndication investment. Some investors just want to buy their own stuff. They want to invest for the long term and never worry about that evil depreciation recapture. You also can buy 3 different completed occupied rental products in 3 different cities, all at a fixed 5% interest rate from the lender of your choice. fixed 5% interest rate from the lender of your choice. I'll explain that. First, finished and leased up rental townhomes in Raleigh, Durham Metro. These again come with that fixed 5% interest rate. Second, finished and leased up duplexes to the north of the people in Utah here. These are in Idaho Falls. So we have one duplex left out of 66 units. Or you can buy gorgeous rental fourplexes at the university in Houston. We have one left. So, sorry, two left. Take a look at the pictures on the right. All of these are real pictures. None of them are renderings. If you love open houses, you can actually check out a mega virtual open house that we're doing, half an hour in each property on a Saturday in about 3 or 4 weeks. So check them out. Open houses are fun even if you're not looking to buy anything. All right, time for that shootout. We start our best cities list with Realtor.com's list of top 10 housing markets positioned for growth in 2023. And we immediately immediately have a WTF moment because all 10 of the cities in our first top, 10 housing charts would have a zero chance of ever making it to a top 10 list in a normal year. That's how bizarre things are right now. We talk about investing in fast growing cities, great population growth, great job growth, long term fundamentals. Well, they're completely missing from this list. In fact, only one of the cities, Worcester, MA, which is number 4 on this list, had population growth faster than 1% in the last decade. All of the rest had population growth and job growth. I mean, close to, maybe even lower than the US average. In fact, 2 of the cities on this list, Hartford at number 1, Toledo at number 10, they committed the cardinal sin of investing. They lost population. Toledo lost a stunning 17,000 people in the last decade. So what the heck is going on here? Here's a clue. When it comes to price gains in 2023, only a single word matters. Just one word: affordability. It's not population growth. It's not job growth. It's not crime reduction. It's not schools. It's one word: affordability. Here's Knox list, and it's more like what we are used to talking about, right? So look at that: Vegas, Phoenix, Austin, Dallas, Denver, SF, Salt Lake. All of the usual stars are here. But wait, this is a list of fastest cooling markets. So all of the fastest markets from last year are now buyer's market? Yes, we're in the upside down here, and that's why I have whiplash. I repeat, there's only one word that matters: affordability. And everything on this list is insanely unaffordable. So the big question is, how long are we going to stay in the upside down? Because given what we know, we cannot recommend a city from that first list, with one exception, by the way, Grand Rapids. So to figure out what happens after the market corrects, let's look at a list that is a new favorite of ours. Not this year, but next year. Which cities in the US are going to benefit the most from manufacturing returning to the Americas? And here's that list. Luckily, we do see most of the usual suspects in that list. So most of the superstar cities will benefit: San Jose, San Diego, San Francisco, Nashville, Portland, Raleigh, Durham, Phoenix, Austin, San Antonio, the usual stars. So there's 3 notable cities in this list that I actually skipped over deliberately. The one at the top, Grand Rapids, Michigan, Detroit, Michigan, and Tulsa, Oklahoma. We will not recommend Detroit to an investor because it loses population. Now, we are watching Tulsa, Oklahoma very closely, and that leaves us with Grand Rapids, Michigan. So over the last 4 years, Grand Rapids has been a very strong performer, sometimes staying just outside the top 10 in many lists. But did you notice it was number 10 on the Realtor.com list that I showed you? And it was the only city in that list that we would recommend. And here it is at number 1. We also want you to note that this city did not see massive home price increases in the last 2 years, so housing is relatively affordable in Grand Rapids, and we recommend this city to you if you're looking to invest. You may also want to look at Tulsa, Oklahoma, which we think is a pretty good bet right now. One final list. This is from Realtor Magazine, which is published by the National Association of Realtor. They give the nod to Atlanta as the best housing markets. Amongst the small markets, notes Rogers, Arkansas. Very interesting market. I've studied it extensively. Greenville, North Carolina. I invested in this market before it became, explosive, and we made a truckload of money. Jacksonville, Florida. Also invested in it before its current rise. Also note that you'll see San Antonio in this list. All right, done with the city lists. You now know what the experts think. So it's our long-standing tradition to finish the 2023 TENS presentation with me sticking my neck out and making two predictions. So I picked the best up-and-coming market in the US. So these are usually smaller markets that have a lot of potential. And then I picked what I consider to be the best market for real estate investment in 2023. If this year's best market does anywhere near as well as my last year's pick, which was Tampa, Florida, I'm going to be absolutely delighted. All right, up first, best up and coming market is Jacksonville, which beats another very strong up and comer, Grand Rapids, Michigan. It's got strong fundamentals. It's got an excellent affordability score, high population growth. So a lot of these show continued growth in Jacksonville. Home prices not as out of whack as many major markets, so price declines in 2023 are likely to be fairly modest and mostly in the first half of the year. Look to buy late in the year, please. And the best market in the US is Atlanta, Georgia. This has been a finalist for us 4 years out of the last 8. It beats Charlotte, North Carolina by a nose. Affordability is what makes it the winner. Amongst the fast-growing superstar cities, Atlanta is the only one that has high housing affordability scores. It's got very strong inward migration. It's got a fast-growing tech industry. It's got a consistent population growth that will continue to attract investors. Expect price declines in the first half of the year. Expect them to be fairly modest. And late in the year, Atlanta would be a terrific pick, both for multifamily and single family. I think this is a market that should do well in both. Jacksonville, also a good market for multifamily, but I think Atlanta's ahead by a nose in terms of multifamily prices. And that's our presentation. Hope you liked it. I'm sure you'll give me questions related to Utah cities. But before you do that, I wanted to point out that in case you're not part of our ecosystem, if you don't get emails from us, we do 20 webinars just like this. They're all created from scratch. There's no reuse of material. And you can register for them at multifamilyu.com. I think we might be able to get you onto our list now that you've attended this session today. But if you're watching a recording, you're not. So please go to multifamilyu.com for amazing data-driven webinars, 20 of them a year. All right, I'm now happy to take your questions. And by the way, feel free to throw your favorite city at me if you like. Back to you, Emma.
All right. Thank you so much, Neal. Fascinating stuff. I'm glad that we're recording this because I did see a couple of comments that we're going to need to go back and watch the economics portion again to really get our heads wrapped around what's been going on. But to recap, rents going up, but not double digits for a while. And it looks like the East Coast is swinging back at the West.
It is. I think the West is going to be quite challenged this year. Obviously, Utah is one of those 6 or 7 states that you saw a lot of red. So just to go back to that particular slide, expect home prices to continue to drop in all major Utah metros throughout the year. So here's that chart, and that's you. It's not looking good, right? So don't expect that picture to change, but keep in mind Utahns love multifamily, which means that as prices drop for multifamily in the first half of the year, expect them to pick it up. So one interesting stat about Utah is that they keep their multifamily twice as long, which means, with the exception of 2008 when everything capitulated and basically, it was different from most other recessions. But the Utah market tends to be very tight for supply, especially for multifamily, but also for single family. So expect prices here to drop less than Phoenix, drop less than Boise, but they will drop and it will be a double-digit drop.
Well, my husband was laid off in November, and the first thing I said to him was, "Why are we here?" So we spent 20 years in Austin, really benefited from the housing market there. Then we've been in Salt Lake City for 5 years. And now that we don't have to work anymore and we're not tied to a location, we are actually heading to Florida because I feel like the whole market from Atlanta down to Tampa is just exploding. So we're going to go spend some time there and see what there is to see. Sounds like it's a good place to be.
I think so. One of the things that I wanted to point out was, one of my early slides that was talking about, multifamily prices. multifamily rents, Oklahoma and Tulsa were big winners there, which is unusual, by the way. Neither Oklahoma nor Tulsa are often in those top lists. But right after those, did you notice that almost every city was Florida?
Yeah,
So top
I
10.
definitely did.
Yeah, yeah. So I think Florida is doing really, really well. Sure has affordability challenges. You might see some
Mhm.
price declines. I can tell you that the Sarasota to Fort Myers area is likely to see double-digit price drops, but that area has gone up so much, right? So look at this. This is, as not this slide. I'm going to pick a slide that I consider to be the most important. This is really the most important slide. Do you see this black bar, right? This is the US, correct? So can you imagine a whole bunch of places above this? California is above this. Salt Lake is above this. All of Utah is above this. All of Idaho is above this. So there's a bunch of cities above this and a bunch of cities below. What's below it? The Midwest, and that's why they're not losing any population and any home prices because they didn't gain as much. But all of the hot cities are above this list, right? And Florida, a bunch of their places like, Sarasota, Fort Myers are also above this list, and they'll fall. They'll fall below this place. They'll come up here. But still, this gap, that is an insane gap. It's still, if Sarasota or Fort Myers drops 20% from here, the black gap in Sarasota to the green gap will still be the highest in history. Remember, this is the highest right here. This is the past champion. And almost every city in the US is going to beat it after the correction we are about to see.
Just riding it out at this point, honestly, just try not to sell anything this year and see what we can sell it for next year. So, all right. Thank you so much again, Neal. I want to open it up for questions. If you want to, there's a little reaction button at the bottom of the screen. If you click on the reactions button, you'll see a little icon that says raise your hand. And we will just go through whoever is in order. Raise your hands first, and I'll call on you and you can ask a question. Make sure you check the chat if there's a question there. Okay, so let's see. I'll put my hand down so I can see who's here. All right. It looks like first hand up actually is Nundi, and she is the one who organized this meetup for tonight. So everybody say thank you to Nundi for bringing Neal to speak to us on this topic. And especially I like the opportunity to relate it to our local markets, wherever it is that we live around the country. So Nundi, fire away, and then Kathy after that.
Thanks, Neal, for coming. We really enjoyed the presentation. I'm in the Austin, Texas area. You had mentioned something about multifamily and how the big investors, they were going to create an inflation in the price for multifamily. According to the data and everything, I just want to make sure I get this right. Would it be better if you're planning to buy multifamily to do it toward the end of 2023 and not wait for 2024 to see price go down?
So you're going to see prices go down for multifamily this year. It's almost a guarantee at this point because the Fed continues to raise interest rates. They will raise rates again tomorrow or day after, day after. So we'll see whether it's a 25 basis increase or a 50 basis increase. The way multifamily works is that immediately is going to affect pricing because at this point people just need to figure out if it's 25 or 50 basis points, and the moment that happens, that's going to affect multifamily prices. It makes no sense to be buying multifamily when you know their prices are going to go down in the next 6 months. Now, the big question is, will they go down for 12 months? And my answer is no, because of something that most investors do not understand. So people believe that the Federal Reserve needs to drop prices for multifamily prices to go back up. That is not true. There is no evidence of that. So here you see the Fed's going like crazy like here, right? The moment the Fed plateaus and signals that they've plateaued, here's what happens. Today, when you buy a multifamily property, Nandi, you're paying an interest rate that has two components. The lower component is basically the base rate which you see on the screen, right? That's the base rate. We call it LIBOR or SOFR. Then above that is what is called the risk premium or the spread. Usually the spread risk premium, there's someone talking, please mute yourself. Usually the risk premium is about 1%. Right now the risk premium is 4%. Why? Because no one knows where the Fed is going to stop. But the moment the Fed stops, shouldn't that risk premium come down to 2% or maybe even 1.5%? So interest rates do not need to decline for multifamily prices to stabilize. They only need to stop going up. And I think that that happens in the first half of the year. By June, July, the Fed will say, okay, we're done. We're just going to stay here for a while, maybe for the rest of the year. And the moment that happens, the panic in the market subsides and the spread drops even though interest rates haven't dropped. And that allows multifamily prices to stabilize. To me, that's the bottom or fairly close to the bottom, and I'll be buying them.
Okay, so the best window would be towards the end of the year then.
I'd say put a property in
According to that.
contract in June, July, because if you're super lucky, Nandi, you wouldn't close until November. You don't want to actually put the property in contract in June and then close in August. You want to drag it out for 5 months. You know why? Because by the end of that time, you'll get the lowest risk premium, the lowest spread, and also possibly 1 or 2 rate cuts.
Thanks.
All right. Let's see. Fed
Okay.
decision on interest rate will be this Wednesday, Feb 1st. That's right. I think that's day after tomorrow. So I'm curious to see if they go up 25 or 50 basis points. Let's see.
All right, Kathy is next. I'll scan the chat and see if we have any that we missed in there as well.
Okay, hey Neil. This is Kathy Leiby. I'm here in Denver, Colorado. You mentioned in your slides, correct me if I'm wrong, but you said that rental rates should still be flat or even still increasing, increasing across markets, right?
That's right.
That's what your data is showing. So my question is, you know, looking at how do you compute or add into your computation the negative, to me alarmingly negative absorption rates that is being seen around the country for the last 2 quarters, and going into 23. What do you make of the negative absorption rates?
So I think that obviously anytime an economy weakens, you're going to see negative absorption rates. So a lot of people say we have a shortage of multifamily in this country. I always like to remind people we have a shortage of multifamily in this country when we have, the economy doing well. When the economy is not doing well, we don't have a shortage because people go live with their mom, or they go live in a garage, or they go live in a car. They two families go live together, and we're seeing all of those things happening. But I don't think that the word alarming applies to vacancy rate, Kathy. We've seen vacancy fall from roughly 96%, which is obviously a phenomenal rate. It's much higher than normal, to about 95%. Of the half a dozen predictors, one of them is on the screen, none of them expect the vacancy rate this year to drop by more than 0.5%. You might say, why? Shouldn't it drop more? Yes, but did you not see how expensive homes are to buy? So normally there's always people that are leaving rentals and going over into the home buyer market. Today it's almost impossible for people to buy, which is why we're seeing that 50, 60, 70% drops. We're seeing very, very low home volumes. And so those people that are not buying, they still have to rent. So I do expect the vacancy rate to increase. But as you can see from the screen, this red box, it's not increasing by a lot. It's slowing. In fact, I don't expect vacancy levels to go up a lot more from where they are. I think that we were at 4.8%. We're going to go up to 5.1. That's not alarming at all to me.
So, yeah, I guess it depends on the market, because some markets, their vacancy rates have already shot up to, like to 9. There's even like Huntsville, Alabama, I think is at, if I'm don't quote me on this, but I think it was Huntsville that's at like 13% vacancy rate. These rates have just shot up in the last quarter or two. But maybe what you're saying is that with interest rates from the Fed going even higher, making that house affordability even less, that, yeah.
Yep. I mean, that obviously is going to create more renters. They may not be long-term renters, but in the short term, I just don't see why there wouldn't be more renters, right? Look at this. I mean, this is just
Yeah,
insane,
yeah.
right?
But
Let me go
rental
back to
rates have
Huntsville,
to come
Alabama.
down. Rental
Huntsville
rates
is
have to come
not.
down.
Yes, they well, I don't believe rental rates will come down because if rents increase, so here's the forecast, right? If rents increase by 3.9% next year or this year, and inflation is at about 6%, I think it's a little higher than that, to be honest, Kathy, then rents are negative. If you go back and look at how rents did in in the high inflation years in the 80s, I have a chart for that. Rents were always above inflation. So if inflation was 6%, rents were 7. If inflation was 9%, rents were at 10. So what I'm saying is this will be an exception because of affordability issues, that we will actually have negative real rents, 3.9% rent growth in a year that has 6.5% inflation. So it's actually pretty bad, but on a nominal basis, it's still positive rent growth, right? Now, Huntsville, Alabama is a special case. There's a few of those special cases. They had 3,000 construction units coming in. When a large amount of construction comes in into a weakening market, it drives everything down. It doesn't mean that the value add properties in Huntsville, Alabama are 13% down. They're counting all those empty new construction properties. The value add properties in Huntsville are likely to be in the low 90s, 91, 92%. I'm sure it's stressful for people there, but it's not as bad as you think.
All right, I've got a couple of
Okay, thanks.
questions in the chat here. Christine Shu asks, are you accepting funds, like a fund of funds into your projects or co-GPs?
Yeah, I think that if you're looking to be an equity raiser and bring, money into my projects, it's something that you can send me an email for and we can have a conversation. So I won't say yes or no. I'll say I'm happy to have a conversation with you to figure out if there's a way for us to work together.
Okay, and we've got a couple of questions in here that are about the project specifically. I want to do a cutoff at 40 minutes past, just so we can
Sure.
respect Neal's time and make sure everybody gets out on time. So if you have something specific on the projects that Neal mentioned, please feel free to reach out to him directly. Let's see. So Christopher Borden says, I think there's a caveat with a drop in sales, especially of single family homes. More and more of these are pulled off the market and then converted to rentals. Oh, like the build to rent single families or okay.
Yeah, but the transaction still has to happen. So what Christopher's saying, I don't agree with. He's saying with the drop in sales, especially SFH, more and more of these are pulled off the market. Well, were they SFH, were they rentals to begin with? Because if they're rentals to begin with, they're not increasing the number of rentals. If they were single family homes and are now being converted into rentals, you're not going to get a lot of rentals. Sales volume across the US is horribly, horribly down. So we can't have both of these things happen. You need substantial sales volume for these to be converted into rentals. Right now, we're just seeing the market freeze all across the United States. It's just frozen. Nobody's selling anything. And why? Because they have home equity. This is not 2007. They have massive amounts of equity. So we're just seeing massive declines in sales volume in every market in the US.
All right.
So,
Next. Oh, sorry.
I do have one I want to pick. So I expect vacancy rate to increase higher for Class C and D. Actually, that's not true, Dean. Vacancy rate in a recession increases more for Class A. Vacancy for D, or well, I'm not going to comment on Class D properties, but for Class C, vacancy actually doesn't increase as much for Class C. You know what increases for Class C, Dean? Delinquency. Operating income gets hit the hardest for Class C properties. Notice on the screen that I'm going to show you, rents are up 3.9%, but gross income is up 3.5%. Why? Because in a 6% environment, salaries go up, expenses go up. So gross income's going up 3.5%, rents are going up 3.9%. In the same way, Class C, you're not going to see much of a vacancy, but because there's delinquency, your gross income's going to drop quite a bit. So in previous recessions, Class C does not get a huge increase in vacancy. They do see a huge increase in delinquency.
All right.
All right.
I will let everybody know where this recording will be posted. I'll email it out to my list and post it on our Facebook and our LinkedIn groups. One more question. Sorry, we don't have time to get to everybody, but Kirsten Choss has been waiting the longest. And so Kirsten, why don't you unmute and ask your question, please?
Thanks so much, Emma. Neal, can you go back to the slide on real interest and just touch on that again? I was not clear on what you were saying.
Sure.
And how it's actually lower right now.
Yes, so it's kind of a weird sort of slide. So let me find it for you. Real interest rates. Here. All right. One of the key things is, let's say inflation goes up to 50% and rates are still at 6%. Inflation is very, very high. The value of money is being reduced. So the fact is, this gap that's opened up between inflation and nominal rates means that when you're borrowing, you might be paying more. You might be paying, instead of paying 4% last year, you're paying 6%, right? You're paying 2% more. So you're like, wait a minute, I'm paying 2% more. How can this be less? But inflation was at 2%. Now it's at 9%. The gap is not 2%, it's 7%. So inflation went from 2% to 9%. But you are only paying 2% more. Shouldn't you be paying 7% more? And if you're not paying 7% more, doesn't that mean that you're actually getting a benefit? It's not super clear, but it's super powerful.